Welcome out to Tackle Trading 101 here tonight on Monday. This is Coach Matt. We're going to have a lot of fun here tonight as we dial in a webinar on swing trading. And this is a webinar I put on about every 6 months or so in Tackle Trading's YouTube channel. Basic introduction into the art of swing trading. And so we're going to get into it tonight. We're going to define what swing trading is, and we're going to get into the process of evaluating a swing trade. And we're going to prep a trade here later on tonight as well. Plan on right around an hour here tonight in the webinar. And like I said, let's have some fun here tonight. I know some of you have some experiences as a trader, so this might be a little bit of a review. Tackle Trading 101 series is designed for new traders, introducing these concepts to the market. And so we're going to have a lot of fun, bring the heat. I'm certainly going to do it as well. For those of you who are new to tackle trading, my name is Coach Matt Justice. I'm an entrepreneur, trader, and investor. I'm a founder of the Trading Justice podcast. I'm also a trading coach, mentor. I'm a father. I'm a husband. I'm a co-founder and the CEO of TackleTrading.com as well. And with that introduction, before we get into the concepts I want to talk about here tonight, in the meat of the program here tonight, the swing trading, what it is, how do you do it type scenario. I want to talk a little bit about tackle trading as we have new traders coming into us here tonight. We got new members of Tackle Trading on our YouTube program that we would like to see you become a pro member of Tackle Trading as well. And so just by way of introduction of Tackle Trading to you that are perhaps new to us at Tackle Trading, we're a very rich community with a tremendous amount of content to our community. We have podcasts, the Trading Justice podcast. We put out reports every single week. We do trader shows for our pro member community. We have tremendous amount of education for our pro member community. And we also have premium systems, coaching, you name it. If you need it, we have it from an education or an application perspective. And this webinar here tonight in swing trading, it's the launch and the start of our holiday sell season at Tackle Trading that we do every single year. This time after Thanksgiving, all the way through the first of the year, we put a lot of our products, educational products, on discount for people to take advantage of. Coaching systems, annual memberships at Tackle Trading. You know the drill, pro members. You can, get your annual pricing throughout the holiday sale season as well. And so if you have any questions on any educational product, any application product, or what is good for you, you can always sign up for a consultation with the amazing Coach Sylvia Cook. She's in the webinar here tonight. I saw her chatting in YouTube just a moment ago. She is absolutely amazing. She will help you out, dial you in, and help you create a plan from an educational perspective. So if you ever need to sit down with the tackle coach, Coach Sylvia, or another coach at Tackle Trading, you can always set up a consultation at tackletrading.com/schedule-consultation. And for those of you who are looking for a nice little community to join and be a part of and learn and grow and connect and succeed together, well, that's what the pro member subscription of Tackle Trading is all about. And you can test that out for free, 15-day free trial at bit.ly/join tackle pro. And with that said here tonight, what we're going to be focusing on here tonight in the meat of the program here is we're going to be talking about swing trading. It's a swing trading was the first style of trading that I was introduced to. It was the first style of trading that really spoke to me. And for those of you that are traders out there, you kind of know what I'm talking about when you say it spoke to me. It just made sense. The conversation over swing trading just made sense to me many years ago, and it's stuck with me all throughout the years. But we're going to get into what is swing trading. We're going to learn about trend analysis. What are the patterns that we talk about this all the time at Tackle? What is the pattern? Well, in a trend is made up of different patterns. And those different patterns, I've labeled the 1, 2, 3 pattern at Tackle Trading. We're going to break down what is 1, what is 2, what is 3, what are the expectations of what we see from a technical perspective as we go into the breakout, the overextended, and then certainly the retracement analysis. And by the way, for you pro members later on tonight at 8:30 p.m. Eastern Standard Time, pro members, Step System Mastermind Group. We're going to have a conversation on the depths of the retracement. So get excited about that one as well later on tonight for the pros. We're going to get into understanding support and resistance. And then at the end of the webinar here tonight, we're going to take a trade. I just threw my phone. We're going to take a trade and we're going to prep it. We're going to take a trade off a current scouting report that we put out every single week for our pro members, and we're going to prep the trade. And so let's have some fun. And for those of you who know me fairly well, you know I have a deep respect for a trader by the name of Jesse Livermore, one of the greatest traders of all time. And we're gonna tell the story of swing trading a little bit through some quotes of his throughout the many years ago. The first one he said was, "There is nothing new in Wall Street. There can't be, because speculation, and that's what swing trading is. It is speculation. You are speculating on the immediate direction of a tradable asset, because speculation is as old as the hills. It's been around since the dawn of time. Whatever happens in the stock market today has happened before, and it will happen again." This is one thing new traders really struggle with. They think things are new. They're not. They're new to you. They're not new. They're you might have just learned it, but they're not new. The techniques that Jesse Livermore traded 100 years ago are very similar techniques. Obviously, technology changes, the speed of the market changes. We have to adapt to that. But the fundamental principles that he speaks about in terms of speculation is as old as the hills, because it's based on our human nature that really doesn't change very often. And so, what is swing trading? Swing trading is a speculative short-term trading system that you are expecting to be in a trade somewhere more than one day, and typically less than 2 weeks. And so you're in a trade in a very short term. You're trying to take advantage of momentum in the market, technical patterns in the market, the current trend of the market. What we're not going to talk about here today is central bank monetary policy. We're not going to talk about China. We're not going to talk about inflation. We're not going to talk about geopolitical situations. We're not going to talk about US political situations. We're not going to talk about anything that has anything to do with an opinion, because that's not what swing trading relies on. Swing trading is more technically driven. What is the trend? What is the pattern? Where is support and resistance? Where are you looking to trigger? All of those are far more important conversations to the swing trader than what happened on the overnight price action out of China, or what is Jay Powell going to say on Wednesday, or what is the PCE report going to be talking about on Thursday. Those are conversations we have from a longer term perspective, understanding the general makeup of the market, the mentality of the market, where the market wants to run, not in the next few days, but over the next few weeks, few months type scenario. Swing trading, highly technical, short term, longer than a day, typically shorter than 2 weeks. Typical time frame in a swing trade is somewhere around 3 to 5 days in this current market condition. It'll change though, because if consistency is in the market, you'll let it run a little bit. If the market's a little bit volatile, you'll cut that loss short a little bit. And so it does change on the average time frame of the swing trade. But in general, you're really talking about short-term trading, pivot to pivot type formations, where you're treating it extremely technical from a trading perspective. Now, when you look at the swing trading in general, there are 4 categorizations of traders that we like to look at from a time frame perspective. And you'll hear me talk about this quite a bit in the halftime report when I talk about what's the daily chart doing, what's the weekly chart doing, what's the intraday chart doing. Multiple time frame analysis becomes very important to swing traders, as they like to not only see the momentum in a short-term perspective, but they like to see a little bit of tail behind their backs as well from a longer-term perspective as well. When you're looking at the types of traders, we categorize 4 of them: day traders, swing traders, position traders, and investors. Now, day traders are traders that will get in and out of a position in the exact same 24-hour time period. Typically, they work off intraday charts, 2-minute, 3-minute, 5-minute, 15-minute, 30-minute type charts. They're looking to get in and out of a position in the exact same day. Now, day traders are typically trading bank opens, economic reports, standard intraday trends. But what they're not doing is focusing on 2, 3, 4 days from now. That's what the swing trader is doing, because the swing trader will look at a lot of the same type of data that a day trader will look at, but they're projecting longer than intraday. They're going to be projecting 3, 4, 5, 6, 7 days out from here. And so the swing trader is going to be a little bit more longer term than that day trader. Now, the swing trader's mentality is really, really simple, ladies and gentlemen. We want to take advantage of the trend. We want to take advantage of the pattern, and we want to buy as near to support as we possibly can, so that we're controlling our risk and maximizing our probability. But in swing trading, in general, what we consider it to be is what is known as pivot to pivot. Now, a pivot in the market is a change in market direction. You see a pivot here, you see a pivot here. That change in market direction is not just one day. To create a pivot in the market, you have to have a minimum amount of time up and a minimum amount of time down, so that we don't get just yin and yang in the market with one day up, ooh, pivot, one day down, ooh, pivot, one day up, pivot, one day down, pivot. That you got to have more consistency than that. And at tackle trading, we put that pivot formation in 3 days. And so you need to have at least 3 days in an upward movement in price to create a support pivot. Same conversation on the downside with resistance. We'll get into that technique here in just 1 second, but I just wanted to take a moment to describe what that pivot is, because it's not a singular moment in time. It's not like all of a sudden one day we're like, that's support, that's a pivot, that's go. That it's a little bit more nuanced than that. And we'll get into that here in just 1 second. When you look at the swing trader, the simple reality is that the swing trader wants to take advantage of the known conditions in the marketplace. We call it pivot to pivot. You're looking to buy at support, sell at resistance. Buy at support, sell at resistance. Now, that's obviously on a bull trade. On a bear trade, we want to sell at resistance and buy at support, but that's a conversation for just a little bit. For right now, it's just pivot to pivot. I'll get into a little bit more detail here in just 1 second. Now, position traders are a little bit more longer time frame, but they're very similar to swing traders. I'll dial in the difference between the two in just 1 second. But unlike swing traders that are pivot to pivot or will make management decisions at resistance or support, trend traders or position traders won't. They'll adjust stop loss over time. And when you really look into the difference between the swing trader and the position trader, it's as much of a mindset as it is anything else, because they're really going to be looking at the same type of trend and pattern. When you're looking at the beginning of a trend, it looks something along the lines of this. You start with some degree of neutrality is what you start with. And then you look at resistance. And once it breaks out of resistance, that is the birth of the trend. That is starting point number one. That would be the first pattern within a trend, is the breakout. And so once it breaks out, you now have the beginning point of a trend. And swing traders will love that. They're like, ooh, breakout, let's go. Position traders will love that. Breakout, let's go. Investors will love that. Breakout, let's go. We all have the same mentality towards the breakout. The difference is stop loss management or stop loss placement and stop loss management. And so whereas the swing trader says, let's buy that breakout, they're going to be adjusting that stop loss over time. And so as the stock goes up, they're going to be taking that stop loss and they're going to be adjusting it over time, making a management decision fairly, and not every single day, but they're at least going to make the decision on a daily basis whether or not to trail the stop loss, whether or not to adjust it, whether or not to scale out, lock in profit. They're going to be making these management decisions as the trade is going up, because they're swing trading. Whereas if they were position trading, the same type of trader looks at the same type of situation and they say, yeah, We like the breakout too. The breakout looks strong. We're going to trade the breakout, but we want to stay in the trade as long as the trend stays intact. And so, whereas the swing trader will adjust that stop loss over time, thus most likely getting out before it even gets into their T2 target, what the position trader says is, no, 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 no. We're not going to micromanage anything here. We're gonna give it a little bit of room to breathe. We like the trend. We not only like the pattern, we like the trend. And as long as the trend stays intact, i.e., higher highs, higher lows, the position trader says, I'm going to adjust the stop loss over time. But unlike adjusting it underneath a daily candle low or an intraday support level, the position trader looks at those support pivots over time and adjusts that stop loss over time, thus giving it a little bit more room to breathe. And so when you're looking at the differences between specifically swing traders and the position trader, it's not necessarily on the technique on the entry technique. We like breakouts, we like retracements. It doesn't matter if you're a position trader or a swing trader, you're gonna like both of them because those are breakouts and retracements. That's what trading is. I mean, that's what every part of trading is. Whether you're a day trader and you're doing it on a 15-minute chart, or you're a swing trader and you're doing it on a daily chart, or whether you're an investor and you're doing it on a weekly, monthly type chart, we love breakouts. We love retracements. That's what all trading is about. And so the position trader says, I like the trend. I like the pattern. I just don't want to get out. I don't want to micromanage the trend. I want to stay in as long as that trend stays intact. So swing traders are simply trying to take advantage of the swings in the market, whereas trend traders are looking to take advantage of the entirety of the trend. And a lot of the differences between swing traders and position traders is, again, not on necessarily the entry techniques, but on stop loss management over time. I just want to take a moment to describe the differences between swing traders and position traders, because there are a tremendous amount of similarities between the two. Both of them are technically driven. Both of them are placements of stop losses, and they're looking at trends and patterns, and they're trying to get into the position on a breakout or a retracement. The differences are stop loss management and targeting. In swing trading, targeting becomes extremely, extremely important. Whereas in position trading, it's not as important, given the fact that you're really tracking the support levels and the increases of support over time. Now, at Tackle Trading, we believe in three pillars when it comes to technical analysis. And at Tackle Trading, we put great emphasis on all forms of analysis. We have deep respect for fundamental analysis. I'm currently putting together the 2023 edition of the Tackle 25. That is a fundamental driven list, and we're very proud of the Tackle 25. Would put that list up against anybody's list out there in the market. I don't care what bank comes out with their A premium type list or their great list. I'll put the Tackle 25 performance against any one of those lists, and that doesn't include the dividend. That doesn't include the cash flow. I'm just talking directional on that. But the reality is that is a fundamental driven list. We respect fundamental analysis at Tackle Trading. We spend a lot of time on top-down economics and behavioral analysis. We put a lot of emphasis on that degree of analysis in our halftime report. But when it comes to swing trading, those forms of analysis are a little bit dated. They're a little bit more opinion driven, what I personally think of a certain condition. Whereas in swing trading, it's really just about the technical condition, the technical analysis that we're kind of looking at. And so the three pillars of tackle trading are really, really simple from a technical perspective. Number one, and I want you guys to write this down in your notes. Number one, and by the way, you write something down because you want to lock it down, right? Price is king. Price is king. Price is queen. Price is everything. Price is absolutely every key component in forms of analysis when it comes to swing trading. If you're not evaluating the price, you're doing it wrong, because the price tells us truth. What fundamentals tells us, what behavioral tells us, There's a lot of opinion in those. What you think of a company versus what I think of a company. What you think of the economic condition, what I think of the economic condition. We can debate until the cows come home on those, and we'd learn from both each other in that. That's why we love community, so that we can have those open conversations to understand and see more about what's happening in our world. But when it comes to swing trading, those conversations are null and void. They end when they begin, because price is king, price is queen, price is everything. We don't care about an opinion when it comes to the art of trading. We care about the trend, we care about the pattern, we care about support resistance, we care about the candle. Those are the things we care about. We do not care about opinion driven analysis. And again, not to discount that. We do a lot of that in our halftime report, but that's not what swing trading is. Number two, price moves in cycles and trends. It's not random. Price moves methodically. Price follows momentum. Price cycles. When you understand trading, you understand that there's a cycle in everything. From day traders and the 24-hour cycle that we track through the banks in the currency market, to long-term cycles from a central bank monetary business cycle perspective, from intraday to the longest time frame, there is cycles in everything. And one of our jobs as traders and investors is to find the cycle, find the pattern within the cycle, so that we can always trade in the direction of price and cycles and trends. And so price moves in cycles and trends. And then number three, history repeats itself. Speculation might be as old as the hills, and so is history. History has a tendency to repeat itself. It is the best barometer of what happened in the past, and what happened in the past is the best barometer of what's going to happen in the future. Yes, we respect the unknown events. Yes, Jay Powell coming out on Wednesday might say something about the market, and it might have an impact on the market. You know what? The PCE report might come out on Thursday, and it might have something to say about the market. And yes, the traders might have something to say about the PCE report, but those are unknown events. We have to plan around unknown events. They're variables. The market has variables. We have to learn how to navigate those variables. But history repeats itself constantly, constantly, constantly. And when it doesn't, it needs to stand out. And that's where reversals come into play. By the way, I think we're pretty good at reversal analysis at Tackle Trading as well. Check out the latest reversal webinar I did from about a month ago on the current reversal, and then go look at what the market's done since that webinar. That's why history does repeat itself. Now, at Tackle Trading, the basics of swing trading. If there are three things we need to understand when it comes to processing a trade in the short term, these are those three things. Number one, we got to identify the trend. Everything is part of this trend. What is the creation? What is the general makeup of the trend? Where's support? Where's resistance? What is the pattern within the trend? Where are we at in the trend? Are we at the near? Are we at resistance? Are we at support? All of those things are really important discussions. But at the very beginning of it all, you just got to identify the trend, because the number one rule of trading is don't lose money. And if you're not trading with the trend, you're probably breaking number one. By the way, number two rule of trading is trade with the trend. Number one, don't lose money. That's according to Warren Buffett, i.e., use a stop loss. So when you're wrong, you take a small hit, not a big hit. Number two, trade with the trend. So we want to identify the trend to know the direction we want to trade. There are three trends in the market: bull, bear, and neutral. We'll talk about all three here in just 1 second. The second thing we need to identify is the pattern. Now, pattern recognition is extremely important to short-term traders, because it's the pattern that defines the probability of the next move. Are we at one, breakout? Are we at two, overextended? Are we at three, retracement? We like to make things pretty simple from a technical perspective at Tackle Trading. One is the breakout, two is overextended, three is the retracement. Those are the patterns within the trend. And so when you get into number one, that's identify the trend. Number two is to identify the patterns within the trend. And number three is to identify support and resistance. The reason we want to identify the support resistance. So again, number one, identify the trend. What's the reason? Because we want to trade within the direction of the trend. That is our highest probability. Number two, what is the pattern? The pattern defines exactly what that probability is. Number three, Where's support and resistance? Support, because that's where we want to buy. We want to buy at support. Resistance, well, we need to track resistance because if we're looking for a breakout, we want to buy it above the breakout. And think about it like this: whether we're buying a breakout and it's above the breakout channel, we're buying a retracement at support, we're always buying at support. Because in a retracement, guess what? You're still buying at support. In a breakout, you just broke out of resistance. What's that old resistance new? It's a new support level. So your job is to buy nearest that support as potentially possible. Those are the hallmarks of short-term analysis in trading. It's identify trend, identify pattern, and then we want to identify support and resistance. Now, let's get into pattern recognition just a little bit. When it comes to pattern recognition, there and I've talked about this a lot at Tackle over the years. There's a lot of different ways you can identify patterns, teach patterns. But what I've always felt, especially with newer traders, if I was having this conversation with a bunch of cutthroat swing traders, I probably wouldn't talk about the constellations in the nighttime sky. I probably wouldn't talk about sunflowers. I'd probably talk about Fibonacci analysis and Elliott wave theory. But the reality is, when it comes to patterns in the financial world, those patterns are they're no different than any other pattern that exists in human society. It's literally based in our DNA is pattern recognition. And I'm not going to tell the story tonight because it takes a little bit of time, but I have told the story a lot of times how I taught my daughter how to see the Big Dipper. And when you first look at the nighttime skies, I love stars. I love patterns within the stars. I love the constellations. I'm just enthralled by those types of conversations. And when I was teaching her how to find the Big Dipper, it took her a long time to find the Big Dipper for the first time. Now, mind you, she was like 6 years old, and you're looking up in the Utah skyline at 11,000 feet in the air, and there's 1,000,000,010 stars up there. It's kind of hard to see sometimes. But the next night, the night after that, the night after that, once you teach somebody what to look for in a pattern, it really stands out. And when it comes to the nighttime sky, that's no difference than when I'm looking at 1,000,000,000 different candles on a chart. Yeah, for the new trader, that's like looking at 1,000,000,000 stars in the nighttime sky. It's kind of hard to find the Orion's Belt or the Big Dipper or the little, it's kind of difficult to see just that unique picture, that unique pattern in a sea of 1,000,000,000 stars. Same conversation on a chart. When you pull up a chart and you're looking at, 1,000 different candles with the 4 different data points per candle and trends and patterns, and it's oh me, oh my, it becomes really, really, really overwhelming until you know what to look for. And what I hope this webinar does for you new traders is it gives you the confidence to know what to look for. And that's why I decided to put patterns and trends within a number system. 1, 2, 3, 1, 2, 3. Where are you at? You're in the 1, breakout, go, retracement, go. And so we'll talk about that here in just 1 second. When it comes to a trend, and we'll get into this here in a moment, but when it comes to a trend, there are 3 patterns within a trend. There are a lot of patterns, guys. You have candlestick patterns, you have trend, you have patterns within trends, you have patterns that end trends, you have patterns that continue trends, patterns, right? There's a lot of patterns, lots of them. But for a swing trader, we don't care about all of those. For a swing trader, we care about momentum. We care about breakouts. We care about retracements. Remember, we want to trade in the trend. And so if there's no trend, there's no pattern to look at. And so you got to first identify a trend. So let's say we have a core bullish uptrend, higher highs, higher lows, higher highs, higher lows. And you can see that right here. You can see it establish resistance. It then comes down into support. It establishes resistance. It comes down into support. We have our higher high, higher low, higher high, higher low. Well, again, where are we at in the trend? Where are we at in the pattern? Or are we at near support? Well, the 1 in a pattern, the 1 in a trend, the first pattern within a trend is the breakout. And so once you've established resistance here, when you break out of resistance, regardless if it was a trend neutral or before, it doesn't matter, a breakout is a breakout. When you break out of the previous level of resistance, that's what we officially label a breakout. And so when you break out of resistance, that's tradable pattern number one. It's called the bullish breakout. And what I've always said is if you imagine having a hot air balloon, right? And you're sitting in your house and you have this hot air balloon and you let this hot air balloon go, it's not going to go above the ceiling. It's just going to go to the ceiling. That's like this breakout here. It's just going to go to the ceiling. That's like this breakout down here. It's just going to go to the ceiling. For it to go above the ceiling, you got to cut a hole in that ceiling. And once it does, it goes and finds the next resistance level. That's what the breakout does. It breaks out of the previous level of resistance. And then the expectation is it's going to establish that next pattern within a bullish uptrend, which would be the higher level of resistance. And so one is the breakout. The breakout leads to two, which is the overextended nature. Number three is the retracement. And so when you're looking at the patterns that define a bullish uptrend, it starts with one, the breakout, two gets into overextended, and three gets into the retracement. And so that's what we're looking at. And so, for example, and I'll get into this here in just a moment when we do a little bit of a case study analysis, but that's in general what we're looking for here. We're looking to trade the breakout and we're looking to trade the retracement. At the overextended, this is where you hear us talk all the time because in the halftime report, guys, don't get me wrong, I love doing it. I love analyzing live market conditions. It's one of my favorite things I do at Tackle Trading is every day dial in what's happening in the market on a daily basis. But because we're dialing in what's happening on a daily basis, a lot of times we talk about what to expect next. What do we need to see to get a trade? What do we need to see in this stock, in this sector, in this industry, in this index? What do we need to see? Well, a lot of times when we're going into that conversation of what do we need to see next, it's because it's in pattern number two. If it's in pattern number one, we're just talking about a breakout. If it's in pattern number three, we're just talking about a retracement. But in pattern number two, this is where patience plays because you're overextended. You don't want to be the last person to buy a trade. Yeah, because if you're the last person to buy, you're the first person to lose. Okay, so you don't want to wait till the very end of the trend. You don't want to wait until it gets overextended. All the trading's done at that point. You want to get in on the breakout. It drives into resistance. That's where we're expecting to start locking in some profit. And so once we get into pattern number two up here, once we're overextended, we go into patience as a position. Patience, wait for the next pattern. Are we going to get a high base? Don't know. Are we going to get a flag? I don't know. Are we going to get a retracement? Is that retracement going to be standard? Is it going to be shallow? Is it going to be deep? I don't know. And if you don't know anything about what I just said, guess what I'm going to do later tonight? That's what I'm having a conversation with the step system traders tonight at Tackle Trading is on depths of retracement coming into pattern number two. We might have to have more conversations than just this one tonight. But if you identify you're overextended, and if you're 3-4 days into a breakout, I don't even care where that support level is. You've missed the train. It's left the station. Be patient. Wait for that retracement. Wait for that consolidation. And so pattern number two is just overextended. We're waiting on that secondary pattern. We're waiting on that high base or that flag. In the example I'm obviously showing here, this would be the retracement. It comes down into pattern number three, the retracement, and it looks to get gobbled up there. And then once we break out again, we just do the dance again. 1, 2, 3. It's a little bit more difficult than the 1-2 step. By the way, not a dancer, but I do know how to do the 1-2 because that's the only move I got. 1-2. Well, in trading, we're going to do the 1-2-3 dance, guys. 1 breakout, 2 overextended, 3 retracement. That's the dance. Once it breaks out, we're in 1. Once it gets overextended, we're in 2. Once it comes down to 3, that's the retracement. And so that's kind of the patterns within a trend. And obviously, I'm focusing on the bull side here, but if you flip it upside down and just turn this chart upside around, we're talking bearish because the bearish conditions are literally just polar opposite of the bullish conditions. But for every bullish technique, there's obviously a bearish technique. But in a webinar where you only got 45 minutes to an hour to dial in a topic, sometimes you have to shave off some of that conversation if you understand what I'm talking about on that bear analysis. But again, very, very similar. Now, when it comes to a bullish uptrend in general, the bullish uptrend is just a series of overextended versus underextended. Overextended to the top, overextended to the low. We looked at as the market gets up, 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 you start to get overbought. Traders start to lock in profit, drives down, it gets oversold. You're just seeing the 1, 2, 3 from a cycle perspective. A little bit more of a simplified version of that. We just like to call the higher high, higher low, higher high, higher low, higher high, higher low. The trend continues, the pattern continues, and it's going to continue until it doesn't. We're not the traders that tackle trading to be like, oh, that's been too consistent for too long. If it's consistent for a reason. That's what we say. If it's going up for a reason. That's what we say. We don't question the technicals, guys. We question people who talk about the market. We don't question the technical condition of the market because that's like arguing with truth. You don't want to argue with truth. Technical analysis wins, not what we think of the technical analysis to a certain extent. Now, once again, the core 1, 2, 3 pattern, we're looking at a breakout. That's pattern number 1. We then get overextended into pattern number 2. We then retrace into pattern number 3. Those are the hallmark patterns within a bullish uptrend. Now, what I want to do is I want to go into Thinkorswim here. And I'm going to pull up some stocks from our scatter reports from this week. And for those of you who are newer to our YouTube program and tackle trading in general, every Saturday we put out some reports called the stock and the options report specifically that basically is a list of the best technical conditions in the market. The stocks we're going to look at tonight are on the current reports. This was my rapid fire pick, which is my favorite bull pick coming into the week. Now, this was not my favorite high probability setup. It was my favorite pick because it's got to go or don't. What I like about Yeti here is actually, I'm not giving that. I like a lot about Yeti here. But let me ask you, okay, just looking at the picture of what we just described, are we into 1, the breakout? Are we at 2, the overextended? Are we at 3, the retracement? Just go ahead and let me know there in chat as I keep talking, because I do know there's a 30-second lag there in YouTube. And so once again, 1, 2, or 3. That's the only question. Are we 1, the breakout? Are we 2, overextended? Or are we 3, retracement? Now, since we don't put overextended stocks on our reports, we're probably at 1 or 3. It's all about breakouts and retracements for those reports. This is at pattern number 3. Here's the breakout. It's on the catalyst and nobody caught it because it was an earnings report, but that's the breakout here. Historically, we look at this candle on this catalyst as the breakout. And then guess what, guys? It gets overextended. I remember breaking this one down. It gets overextended. This is pattern number 2 up here. And so pattern number 1, when you look at Yeti here, that's right here. This is pattern number 1. This is pattern number 2. This is pattern number 3. And so you're currently in the retracement. And not the difficulty, but the thing we need to understand is now that we're in the retracement, are we getting the things that we need to see to look for that as a pivot? And my answer is obviously yes, or I want to be, using this as a case study here tonight. And so we're in pattern number 3. Okay, good. Well done. Okay, get those fingers ready, guys. Get those answers ready. I'm looking for some activity here in YouTube here tonight. We're going to bring the fire. You're going to bring it with me. So everybody, get those fingers on that keyboard. Get off Twitter. Get off TikTok. Get off Netflix. Let's focus here on the learning here. Okay, going to pull up some stocks here. You tell me. Rio. What are we in Rio? Are we going into pattern 1? Are we going into pattern 2? Are we going into pattern 3? On Rio, what do you guys think? 1, 2, or 3? I'll give you about 5 seconds, and then I'm going to keep talking. So Matt says 2. What do you guys think? We're going in. It's a little bit weird, Matt, because you're 2 here. This is where you're 2, right here. Let me just draw it for a second. Give me 1 second. This is 2, right there. Once you get overextended, you see the quick journey here. Up, 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 up. You see the quick journey there, right? Once you get there, Now you see the consolidation play out here. Because we've seen the consolidation play out here, now we're still in pattern number two because it hasn't broke out yet. So technically you're accurate, Matt, but still we're going into pattern number three. And so we're looking at Rio as a potential breakout situation going into pattern number one. And so basically this high base here is the retracement, Matt. And so again, retracements, high bases, they kind of establish the same type of mentality going into pattern number three. This is the breakout here. That would be the retracement here, high base scenario. Once you get into the breakout, you're going into pattern number one. That's why it was on the scouting report. And so I just wanted to pull up an example or two on what we like to look for in swing traders to really understand, are we at one? Are we at two? Are we at three? And it might take a little bit of time to understand, especially if you're new, but it's like riding a bike once you get it, guys. It's just never going to leave you. That dance, 1, 2, 3, 1, 2, 3, 1, 2, 3. It's never going to leave you. Looking at Paramount here. Paramount here was bearish. It's going through a little bit of a V-shape potential recovery. It's got resistance at $20 right there. Well, what are we looking at? Para was on the scouting report earlier this week. We're not looking at a retracement. We're looking at a breakout here. And remember, neutrality going into the breakout, that's the beginning point of a trend. And who loves that? Well, the investors love buying lows. Position traders love getting in at the beginning of a trend. Oh, and swing traders. Oh, come on. Coach Frank won't say no to a breakout, and this is a breakout. And so you're looking at going into pattern number one. And so once again, when you're looking at the scouting reports or any stock you're personally looking at on your watch list, you're basically saying, okay, where are we at? What is the trend? We don't have one here. What begins a trend? A breakout. And so once we get that breakout of $20, guess what we're in? We're now in a bullish uptrend. We've seen it start to go up. It just broke out of resistance. And so when you're looking at the market from a pattern perspective, you're just simply looking at the stock from a trend and then a pattern. What is the trend? If we're neutral, well, we don't trade within neutrality, not in terms of directional. Those are more cash flow systems. What do we need to see if it's neutral? Well, pair is kind of neutral in the short term. What do we need to see? We need to see a trend. What creates a trend? A breakout. What needs to happen? A breakout. If it breaks out, we have a trend. And yes, we do like breakouts. And so we're looking at a breakout, and that establishes the trend that we therefore will be tracking the overextended, the retracement. And the simple reality is this, ladies and gentlemen, if you miss pattern number one on the breakout on para, it's not the end of the world. It's not the end of the world, not in any capacity. Even if it skyrockets to 24, you're going to be like, oh man, I should have bought it at 21. That would have been awesome. And you know what? It would have been. It would have been absolutely fantastic, but you didn't do it. And that's okay. Because if you miss the breakout, don't chase it. Chasing is going into pattern number two. You're the greater fool. You're buying somebody else's position. That's what's happening. And so don't chase it. Be patient and let it come to you, either through a retracement or a base. And so once you get up here overextended, you simply wait for that secondary pattern. You're in pattern number two, wait for the secondary pattern. What is the secondary pattern? That's the retracement or the base. We look for one of those two hallmark type scenarios before we look to trade again. And so that's what we're looking at when we're looking at a bullish uptrend, is we're looking at it from a trend perspective. Trend, what is the trend? What is its pattern? Where is support and resistance? Now, in a downtrend, let me go ahead and erase my lines there. In a downtrend, like I said earlier tonight, it's just flip that chart upside down, guys. That's all it is. It's just flip that chart. We don't need to flip our mindset. Technicals tell truth. You shouldn't care if the market's going down as a short-term trader. As an investor, we do. As an investor, we absolutely do it. We need to buy insurance if we need. We need to write covered calls and lock down risk graphs. We need to do creative management to mitigate some of the damage to the downside, because we need to control that risk to the downside as an investor. But as a trader, you shouldn't care. as a trader. You know, one of my mentors from a very, very long time ago is the guy by the name of Jeff. And Jeff, his name is Jeff Crystal. And Jeff is such a wonderful technician, just an amazing technician. And he basically said this to me one time. He said, Matt, I'd trade anything. I'd trade my mother. And I said, Jeff, your mother's a wonderful sweetheart. I wouldn't trade your mother. But that's the mindset, guys. That's the mindset. We shouldn't necessarily care where the direction goes in the short term as a trader. We're going to trade the trend. We're going to trade the pattern. Remember, everything else is an opinion based on behavioral analysis or fundamental analysis, your take versus my take to a certain extent. But in trading, it's just price action. Remember the three hallmarks of tackle trading: technical analysis. What's number one? Price is king, price is queen, price is everything. It doesn't mean price has to go up. If price is going down, we'll attach ourselves to that as well. For every we put bear picks on our scouting reports the same way we put bull picks. We like to dial in them both, right? And so in a bearish downtrend, you simply have price that is going down over time. Now, in the simplified version of that downtrend, you simply look at it from a lower low versus lower high scenario. In the core 1, 2, 3 downtrend, you're simply looking at the exact same thing, but instead of a W breakout, now we're looking at an M breakdown. And so the breakdown, when it violates support, that's the first technical pattern that we can trade, is that bear breakdown. That bear breakdown, by the way, is by far the number one most confident pattern in the market in 2022. Now, that is changing. That is changing over the course of the last couple months, because the market's behaving differently. But for the first 8 months of the market, it was breakdowns or it was nothing in the market. And so when you're looking at the breakdown here in that one pattern, that breakdown is one of the most important patterns to understand, and not just from a short-term trade. If you're a bear, you love breakdowns. There's no doubt about it. If you are a bear in the market, it is your number one favorite pattern, and there isn't a close second, because what is underneath support is stop losses. And so a lot of times when the market breaks support, there's stop losses right underneath those support levels that get triggered and create a lot of momentum to the downside. It doesn't matter. We don't chase. If you're not getting in on the breakdown, you shouldn't be getting in. Wait for the next pattern. And so if you miss the breakdown, wait for the retracement. It will always come back to you guys if you allow it to. And so 1 is the breakdown. It therefore gets 2 is overextended, retraces back to 3, which is the bearish retracement. 1, 2, 3, bear breakdown. Now, when it comes to those bearish positions out there, let's take a look at a couple stocks here. Let's take a look at, I just got some bull lists. Let's go to some bear lists very quickly. Here's the bear list from this week. All right, so when it comes to the shorting or bearish analysis in trends, very similar. We want to look for bearish downtrends. We want to look for the 1, 2, 3 pattern. And so it's important to understand what you're looking for. If you're looking for 3, wait for the retracement. If you're looking for 1, you know what you need. Here is the scale's off here because of that 200-day moving average. So let me just hurry and change that just a tad here so we can see the scale. Some of these underbelly stocks, the scales get off a little bit if you have that 200-day moving average all the way up here. Now you can see the pattern a little bit. Now, what do we got? Well, here's the breakdown over here, right there. Here it is again. You get a little bit overextended. How do I know that? Because when you look at this movement to that movement and this movement to that movement, we're about similar. And so when you look at this movement, it goes from about 18.5 all the way down to about 14.5. That's $4 movement. When it goes from this movement, it goes from about 17 down to 13. That's a $4 movement. That's called potential average yield. And so once you get to typically from your last retracement to current support, if this movement here, let me just give the box, is similar in distance and price to this box here, well, you're overextended. That's its overextended nature. And so once you identify you're overextended here at 13, You wait, you be patient. You know you're in pattern number two right here. What do we need to see? We need to see that next pattern. What is it? It's either going to be a retracement or a low base. What is this? It's a little bit of a flag. It's a little bit of a flag, a little bit of a base. There's a little bit of both of them in this pattern, quite frankly. But because the flag's so shallow, you're still waiting for the breakdown. And so you're just identifying the stop. What is the trend? What is the pattern? What do you need to see next? If you're in pattern number two, you know you need to wait for a base or a flag. If you know you're going into pattern number three, you're just waiting on the retracement. And so you're simply identifying that. What about beyond meat here? Same type of conversation. You're looking at net neutrality here. What stops net neutrality? Well, breakdowns, breakouts. That's what cures neutrality. You got to see a breakdown. Where's my line here? For the breakdown. And so we're looking for a bearish breakdown. That'd be going into pattern number one. When you're looking at Coinbase here, Coinbase not in pattern number one. It was in pattern number two just a few days ago. By the way, this was my favorite bear pick from not this week, but last week. I do still like the trade, by the way. But when you're looking at Coinbase here, you're just a little overextended here. It consolidates. Is the consolidation anything to be worried about? In my opinion, no. Why? Because it never came back up above resistance and it never even touched the 9 EMA. There's no momentum here at all. Markets don't go in a straight linear line. They don't just go up, they just don't go down. You got to be able to read the tea leaves just a little bit. And if it doesn't change the dynamic of the breakdown or the pattern, it's not something unique and different. You just need to wait for the breakdown. And so you're going into, once again, pattern number one. When you're looking at, let's take a look at Lucid Motors here. Low base, another breakdown. Why do we like pattern number one? Because it's easy. Overextended. You're at pattern number two, overextended. What do you need to see? Low base or retrace. We got the low base, literally breaking $10 here today. That is a shortable situation. And so when you're looking at the marketplace, sometimes it can be very, very overwhelming with the amount of data that comes into the market, especially from a technical perspective, right? Yeah, you're looking at a chart for the first time and you're like, oh my goodness, Matt, I don't even know what Matt's talking about. Well, it might be because of language. It might be because, I'm speaking a trader's language and you need to indoctrinate yourself into the trader's language. It might be a first introduction. And whenever you first learn something new, it's overwhelming. But please don't make one really bad mistake. Simply because something is new does not mean it's difficult. It just means it's new. It just means we need to go through those learning curves to a certain extent. And so where we're at, and I do this all the time, guys, this is how I navigate those scatter reports. When we're dialing in those scatter reports every single weekend, where are we at? Are we in the breakdown? Are we overextended? Did we miss it? Well, if we missed it, let's put it on the list for maybe next week. Let's wait for that next trade. It's just an identification of where you're in the trend. And so understanding the 1, 2, 3 pattern is just a way that you can categorize the pattern in a trend to know what to look for next to a certain extent. And so that is the patterns within a trend. The last concept that we want to talk about before we get into prepping a trade here is the conversation of support and resistance. And Mark and myself have debated this topic many times, but I think we both come to the same conclusion. The number one most important technical situation to understand is support. It's because that's where almost all the decisions, the real important decisions, the decisions that have a lasting impact outside of just an intraday bump or an intraday drop. Outside of that it's support. We talk more about where support in the market than any other conversation. We want to bias support. We use stop losses underneath support. And so if there's a more important concept from a technical perspective than understanding support, I'm not sure what it is. There's a lot of amazing technical situations to understand and learn, and they all help you navigate the market. But the simple reality, if you learn one thing in trading, buy a support and put a stop loss under support, you're probably going to be in this game for a very, very, very long time. Whereas if you don't have that understanding of support, it's just chaotic. It honestly is. understanding support and where support forms, how we utilize support, it makes the chaotic seem a lot easier to understand. And so support and resistance are absolutely interchangeable, number one. Number two is I want everybody to say hello to Marty. Marty the elephant is two things. Number one, he is the tackle trading mascot. And number two, he is my best friend. When it comes to Marty the elephant, Marty has, for a very, very long time at tackle trading, been very symbolic to us from a technical perspective, because what you can understand simply by watching this elephant, this beautiful, beautiful, beautiful elephant, this majestic, amazing, loving elephant that will break your back and your bones and crush your spirit if you don't put a stop loss under support. But this elephant can teach us so much about the technical conditions of the marketplace. When you're looking at Marty the elephant, it's easy to get fixated on the beautiful elephant because, let's face it, Marty's a beautiful elephant. But what you really should be fixated on is that trampoline underneath Marty, because what that trampoline manifests. That trampoline is what we consider support. Support, and you just watch Marty jump on this trampoline, 15, 16 different times. And every time there was a pattern associated to it, there was momentum in it. There was the concept of support and resistance. Every time Marty hit the tramp, he slowed down, he went back up. Every time he got a little bit overextended, he slowed down and he came back down. And so when it comes to Marty here, Marty is currently setting in 3. Yes, Brent, that is accurate. That he would be in the retracement analysis, I would say, getting ready to confirm as well, right? But when you're looking at Marty, just understand that trampoline is the most important concept here, because that trampoline underneath Marty represents support. Support stops Marty from going down lower and lower and lower. Think about Marty's momentum here. You look at Marty's momentum, and as he's coming down, 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 boom, he's coming down with some heat. He's coming down with some heat. And every time he hits that trampoline, he doesn't go straight up. Marty doesn't go straight up. He slows down. He slows that trajectory down. And then at a moment where he has zero momentum, he springboards back up. Again, I've said this for a very, very long time. If you can understand this little elephant jumping on that amazing trampoline, then you can understand how to trade swing trading. It doesn't have to be complicated, guys. I've been around this industry for a very long time. We educators and traders, we have a tendency to make things complicated. It's not. It's 1, 2, 3, and it's elephants jumping on trampolines. I was having a discussion in Discord in one day for Trade Masters. We do a Trade Masters hangout in Discord every Wednesday. And there was a question on something. I can't remember what the question was on, but I made a statement and I said, listen, the simple reality is this: if you master the basics of trading, like master just what any trader would consider the basics of trading, you're 90% there to be an amazing trader, truly, because the basics are what keeps you consistent for a very, very long time. We traders, we do a terrible job of taking complicated material and trying to make it simple, because traders are not educators. Educators make it simple. Traders make it harder. And so when you're looking at Marty here, understand this is our attempt to make technical analysis simple, because the trampoline is support, Marty is the price. And if you can understand that dynamic of momentum, you can really, truly understand a tremendous amount about why we love to swing trade in the marketplace. And very similar to Marty coming down into the trampoline and forming as support, support is a floor. It's the low point in the chart, ladies and gentlemen. It's the area where demand outpaces supply. So what is driving Marty down, what's driving Apple stock down, or what's driving any stock down, is you have more supply. The reason is not important here from a technical perspective. The reason is not important here from a swing trader's perspective. I'll geek out and debate these things till the cows come home in the halftime report on what this Chinese economic policy means to our market 3 months from now. I'll have those debates on the podcast. Those are amazing conversations. But the truth of the matter is, it doesn't matter as a short-term trader. As a short-term trader, the reason is not important for the causation. We simply understand that as supply is increasing over demand, the market is going down, 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 down. And as demand outpaces supply, we start to see a pivot. We start to see slowing momentum and then that upward movement in price. Marty hits the trampoline, slows down, and then explodes back up when that demand outpaces the supply. That's what creates support. Now, when you look at the creation of support from a technical perspective, it's a little bit of an art. There's no doubt about that. There's a little bit of art here. When you look at the creation of support, and it doesn't happen randomly. Typically, these happen at catalyst. But what happens is the candles that we track in the market, they start to get smaller. And so as the market's coming down, 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 those candles are big, big, big. And as they come into support, you start to see the creation of support similar to that Marty coming down onto the tramp. When he hits the tramp, he slows down. He doesn't stop going down. He slows the trajectory down before he explodes back up. We see this same type of dance routine in the stock market as the candles are getting bigger, 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 sending the market down, 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 down. Well, as those candles start to get smaller, you start to see support coming in. This is what we look for in support building. It's not a singular moment in time. If traders come to us and they're like, hey, where's support going to be? I'm like, I don't know. I can tell you what the catalysts are going to be, but I can't tell you where it's going to form. You kind of got to be there when when support forms in the market, because it's not us that dictates the price action. It is the market that dictates the price action. And so as the market candles are getting big, 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 there's no support. That's Marty coming off pattern number 2, coming with some heat into pattern number 3. We got to see Marty hit that tramp. Big red candles aren't the trampoline. Big red candles are he's above the tramp. And so those big red candles coming down, 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 well, what's happening here? Smaller candles. That shows us that the momentum is shifting because Marty, or the price, has found support. You're seeing the creation of support. And so when you see that upward movement in price, now Marty's bounced on the trampoline. He found the trampoline with the 2 small candles. He pounded the table. He pounded it upwards. He's like, we are going jumping. We're going partying like it's 1999, Marty. And he's going to go back up into the next resistance level. That's our belief from a technical perspective. So increasing momentum candles shows you that the momentum will continue. What do we need to see to change that dynamic? Small candles. Things in motion have a tendency to stay in motion, ladies and gentlemen. That's the famous saying by Isaac Newton. What do you say next? Until an object appears that stops the motion. What is that object? I think Isaac Newton was talking about candles, because that's what stops the motion. Big candles show you that the momentum is down. Smaller candles show you that support is being created because the bears are losing momentum. The catalyst, not as important. They're losing momentum. We see that demand outpace supply. Now we see that upward movement in price. Resistance, on the other hand, well, that's the ceiling. When it comes to resistance, the creation is extremely similar. What's driving the market up is outpaced demand. You have higher demand than supply. Markets are going up, 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 up. As it comes into resistance, demand slows, supply picks up. The reason? Quite frankly, the reason is really, really simple on this one. Traders lock in profit. That is the number one reason at overextended situations why markets come down. We can talk about China did this or China did that, or this economic report or this economic report that. That's for people on CNBC, and that's for people that are analyzing markets. I do that, and I'm not throwing cold water, guys. I do it on the halftime report all the time. And so I'm not throwing cold water, but that's what that is about. The reason is actually not important. The reason is typically traders are locking in profit. but we like to understand why traders are locking in profit. And so again, it's simply traders locking in profit that creates a ceiling in the marketplace. And so as you see the market go up, 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 well, what starts to happen? It starts to rotate. It starts to slow down. Marty's on the trampoline here, ladies and gentlemen. He pounds the table. He goes up, 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 up. Big green candles, momentum-based candles, they have a tendency to continue in the direction of the momentum. The greater full theory, somebody's going to buy it. Somebody's going to buy it. Momentum, momentum, momentum. What stops momentum? Think about Marty jumping on that trampoline again. He jumps up. He goes up. At first, he has a lot of momentum, doesn't he? He pounds the table off that trampoline, and he's going up, 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 up. And what happens? He gets a little bit high. He gets a little bit higher. He starts to slow down. Starts to lose a little bit of momentum. Well, we see Marty turning around here again. What is Marty, guys? Price. That's what Marty represents. That's the entire mascot of tackle trading is an understanding of price. And so price starts to slow, starts to come back down. You have a pivot formation of resistance. Increasing momentum, big green candles, decreasing momentum, smaller candles, does not necessarily matter the green or the red level. Now, where these levels form are not random. The market support and resistance are always defined by the market. Number one, they're defined by supply and demand balances, but they're not random. We can see the trampoline. We can see the floor. We know historically where the market has turned before. Technical catalysts are the areas on the chart that the traders expect support to form. They expect resistance to form at these technical catalysts. Now, some are more important than others, but all of them can be utilized. Some traders have their favorite. I have mine, but they can all be utilized. Once again, a technical catalyst is not support. It is a technique where we oftentimes see support form. But again, support only is formed in the real time based on supply and demand, based on that upward movement in price that was preceded by a downward movement in price. And so when it comes to these techniques, these are levels that were prepared for the trampoline to form. Where can Marty bounce? On these levels. Where can Marty break out of? Against these levels. And so it's these levels that we're ready to take action. Be prepared as the Boy Scouts model, where we want to be prepared for the pivot to form at these key levels of support or resistance. And so the principle of polarity here, old support is new resistance, and new resistance is old support. These levels, once a pivot has been identified in the market, they are certainly interchangeable. And so as you can see, old support was defined. Well, that became a new resistance level. It just so happened to be also at $50. Old resistance here, well, that just so happened to become a new support level. Once that pivot is defined by the market, we traders will look to the history to help us understand where these important decisions of buying and selling were made. Because guess what? Other traders are looking back in the past and saying, okay, where was that buying and selling? Where were all those decisions made? Well, those decisions are made at support and resistance. And so when those decisions were made back here, it doesn't surprise us that it has a hard time breaking out here. But once it does break, typically on a catalyst, mind you, once it does break, well, it acts as a new support level. That's the old support, new resistance dynamic. Those are also referred to as old pivots. And so pivots have a tendency to be pivots in the future. Significant whole numbers. Significant whole numbers are psychological numbers. In times of market volatility, for example, you can throw certain support catalysts out the window. You just throw them out. Like nobody cares about the random trend line you drew when Jay Powell comes out and says we're going to raise interest rates. Okay. Nobody cares about your arbitrary trend line. All right. Nobody cares about your Fibonacci retracement level that you've drawn in times of volatility. Okay. But you know what they do care about? They care about $10. They do. Even in times of volatility, it stands out. They care about 20. And because it's me teaching this class, they certainly care about 30, 50. I got Frankie on 30, by the way. 30 stands out to us. 50, 100, these significant whole numbers will oftentimes, and guys, I'll just tell you right now, um, I think the 9 EMA has been the most important moving average this year. I do think the 9 EMA, it's been so important. Once the market catches momentum, it's been a momentum until it gives momentum, and then once it gives momentum, it's been really hard to recreate that momentum. And so I'd say the 9 EMA is the most important support level. I would say secondarily the 200 SMA on the weekly chart. And so I'd say the 90 EMA on the daily chart, the 200 SMA on the weekly chart, those are the two most important moving averages this year, both in terms of the 200 weekly SMA as a support level, because we talked about that level for 6 consecutive months until it got hit. It was almost like a self-fulfilled prophecy. Don't blame us. But the 90 EMA, once again, has been so important for momentum. But if there's a close third to those two this year, a year of volatility, a year of concern, a year of uncertainty, it has been significant whole numbers, especially in the broad market. And so these significant whole numbers, one of the reasons why I really like the Lucid trade is because not just that it's bear downtrend kissing into support, breaking support, but it's the bear downtrend kissing into support, breaking $10. Those things stand out to us. They stand out to traders, and they always will, because they're up here. And when you think about those significant whole numbers, yes, I personally put 30 into the significant whole number, but that's me. That's me based on what I've seen over the last 2 years in the market. But when it comes to the significant whole numbers adopted by the market, they really go with the currency. And so 5, 10, 20, 50, 100. Those are your significant whole numbers. On this example, you're obviously seeing out at $100. Another example of previous support equals new resistance, trend lines. The hard 14, I love the hard 14 for many reasons, but moving averages, I don't know how technicians do it any longer without a deep understanding of moving averages on a multiple time frame perspective, because the way algorithms use moving averages is not only important in the past, it's not only vitally important today, but it's legitimately one of the most important conversations we're going to have moving on into the future, is how algorithms play a role in the marketplace. And even in the halftime report today, Coach Gino was on the halftime report, and he was talking about how money managers who are tracking mutual funds and whatnot, where they use algorithms based on moving averages, hedge funds that will trade, you know, a million different transactions in 5 minutes. Well, guess what they're primarily utilizing? Not all the time, but one of their primary catalysts is moving averages. And so moving averages have certainly always been important, but I'll be the first to admit that I discounted moving averages for years and years and years. There was about a 7-8 year stretch where I was like, I don't care what the moving average is doing. Like, so what? It's lagging, and I could care less. I would like to make my decisions based on price action. And even though I'm still some of that today, price is king, queen, and country. It's price is king, queen, and everything. I still love, I don't want to say still. I now use moving averages more now than I ever have. Even when I was first introduced into trading, when moving averages became one of those first techniques that I learned, it was fantastic. It made things a little bit easy. But 6 months into my education, I was like, oh, I'm done with that. Who cares? I'll focus on the candle, focus on price, focus on this, right? And so when you're looking at moving averages, though, we all got to admit when things change. And so one of the things that the hard 14 taught me, and again, this was my brother, Coach Mark, putting the hard 14 together, and being the second on that system with him. I just had an open mind, honestly, guys. I just had an open mind. And me and Mark, you hear us on the podcast all the time. You hear us on the halftime report. We're not above arguing with one another, not at all. But when he was dialing in his detail and his data and his historical understanding, I just couldn't deny what I was seeing in front of my very eyes. And so moving averages have taken on a much greater role in the creation of support and resistance at this point in 2022 than, in my opinion, they've been at any point in trading. Maybe back in the 1980s, they were a little bit more important. Maybe in the 1990s, they were a little bit more important, but I don't know. I wasn't a trader back then. I didn't start trading until 05. After 05, I don't think moving averages have been ever more important than they are right now. And I do believe that's going to be a very, very important conversation that we all have moving on into the future. And you know what's cool about that? They're easy. They're really easy. Once you understand them, they can be really, really simple because they're visual. 9 EMA. I don't even know what Coach Mark's calling it. I still call it Janet. I know he's calling it Fergie, but I still call it Janet. That 9 EMA, the 200 SMA, they just stand out. Now that I use the 9 EMA all the time, guys, on every standard time frame of chart, I use the 9 EMA. By the way, it's the only moving average I use on every time frame is the 9 EMA. I'll use a combination of 20s, 50s, 200s, but on every chart I have the 9 EMA. That's the importance of that 9 EMA. I don't know how I'd read a chart anymore without the 9 EMA. You can give Coach Mark a lot of credit for that conversation. By the way, he opened all of our eyes to that conversation. You know, coming back to Jesse Livermore. And by the way, have you guys had fun tonight talking trends, patterns, support and resistance, defining swing trading, all the conversations that we've had today? And I've had a lot of fun. You know, in YouTube, you can't have the interaction that you have in Zoom that we have in our pro member community. But I've had a lot of fun here tonight, and I hope you guys have gotten a tremendous amount of value out of the Tackle Trading 101 here tonight. Jesse Livermore said, do not anticipate a move without market confirmation. Being a little late in your trade is the insurance that you are right or you are wrong. When you look at the concept of confirmation, simply because you have a bullish uptrend sitting in pattern number 3 on your favorite support level with slowing momentum, everything's picture perfect, right? Everything's fantastic. Everything's great. Without confirmation, it's null and void. We don't move without confirmation. Everything you're doing before you make that trade is the preparatory scenario of assuming confirmation. Where we put our orders is to guarantee confirmation. Because like Jesse Livermore said, we do not anticipate, by the way, it's great to have you back, Robert. We do not anticipate and move without market confirmation. And so when it comes to the concept of confirmation, guys, if you think about Marty, my beautiful little elephant sitting on this trampoline, I'm not going to buy Marty simply because, and let's say the 9 EMA is the trampoline. I'm not going to buy Marty simply because he's sitting on a catalyst that has historical relevancy to it. Marty jumps on this trampoline. We've all seen it a billion times. There's historical relevancy to it, but we're not going to do that. We're going to put an order in above Marty. Let me get that green color out of here. That green color I can't really see. So we're going to put an order in called the buy stop above Marty. And if Marty jumps, then we get involved. That's what confirmation does. Everything is ready to rock and roll. You're sitting at support. You've got a bullish uptrend. You're in pattern number 3. You're ready to go. You want to make money. You're going to make money. Everything's beautiful. You still can't do it without confirmation. You just can't. That's gambling. We don't gamble. We trade with probability. We get the edge. And you know what? I don't know what Marty's going to do. Marty historically jumps up to here. That's where I'm going to target, where historically Marty jumps. However, I don't know what the future holds. I do know this. The probability is increased if Marty jumps. That's what I know. If Marty's just sitting on the tramp, he's just sitting on the tramp. That's all he's doing. You don't know if Marty's taking a siesta. He's been jumping forever. For a long time, he's tired. He wants to take a siesta. He has a glass of lemonade. He's hanging out. You don't know. He might be sleeping. He's a big old elephant. He takes naps. When do we want to get involved? When he jumps. So instead of waiting and staring at Marty, he's beautiful. I get it. I do it too. But you don't need to stare at Marty. Just put an order in above Marty, above the price. And again, Marty means price. Put it above the price so that when Marty does jump, you get involved. That's confirmation. And so as the stock is coming down, and we start to flatline, well, this is Marty coming down. This is Marty sitting on the tramp. We like it. We like it. but we don't love it, not without confirmation. And so where would Marty's high be? Right above the candle wicks. And so we put that order in above the candle wicks. So when Marty jumps, when the price jumps, we get involved. Okay. And so I hope that makes sense. But that is the concept of confirmation. And when you look at the concept of confirmation from a price perspective, you see the market. Assume this is a bunch of big black candles coming down, a bunch of big red candles coming down. Christian colored these ones black. He likes doing that to me every now and then. But when you're looking at these candles coming down, assume we got now I can't even draw my candle for some reason. Okay, so when you're looking at these candles here, guys, assume we got some big red black candles coming down. Okay. And so as we got some heat coming down, this is what we want to see. The first candle coming into support, that's typically a bigger bear candle. It's what builds support. You got some heat coming in. It's the first time Marty comes in off jumping and he hits the trap. That's that first candle. It's a bigger candle typically. You see it as a little bit of momentum, and it's a little bit of a look out below, but also below it is typically a catalyst called support. And so candle number 2 is what we refer to as the pivot candle. The pivot candle is typically a slowing momentum candle indicating that support is being formed. And so you got your bid candle coming down, you got your slowing momentum candle sitting on the trend, i.e. support, call it a 9 EMA, call it a 200 SMA, call it a previous resistance level, call it whatever you want to call it. It's sitting at a support level. That's that pivot candle, because historically, if that is the low price, that's what historically we will look to identify that as a historical pivot. And then candle number 3 is the confirmation. We don't trade the pivot candle. We do trade the confirmation candle. The pivot candle is the candle that wakes us up to the opportunity. It's the candle where we're like, I got my trend. I got my pattern. I got my zone. I'm ready to go. Let's go, right? I got that. Now let's see confirmation. Okay. Now let's see confirmation. And so when you're talking about Marty jumping on this trampoline, man, I love Marty. Beautiful elephant here. Okay. But I don't know when Marty's going to jump. That's number one. Marty defines when he wants to jump. I don't get to dictate to Marty when he jumps. Marty jumps when Marty wants to jump. And again, what is Marty? Price. And so when we're looking at Marty sitting on this trap, yeah, we look at it historically and we're like, man, Marty just jumps. If all I ever did was buy Marty on the trampoline, why don't we just put a market order to buy Marty when Marty gets on the trampoline? Because historically, Marty jumps when he gets on the trap. Yeah, I would say yes. And I would also tell that's foolish, quite frankly, because we don't move without confirmation. Everything is just a matter of prepping until we ultimately see that confirmation. And so when Marty gets on that trampoline, it's time to put the order in. We put an order in to buy Marty when it goes above resistance. We want to get filled as Marty just jumps and has fun. But it also helps us understand where we want to put a stop loss, because support is not a finite number. It's a zone. And so what we're trying to do here as Marty comes into support, we're trying to identify where the zone of support is so that I can get a stop loss, so I can get an entry above Marty here and put a stop loss underneath Marty there. And so if Marty does in fact jump, well, guess what, guys? We have an order to get filled when he jumps. When the price jumps, we get into the trade. Our order's here. And then as Marty goes up and up and up, we take this and we just trail it up until he comes back down. That is the concept of confirmation. Like I told you, you can learn a lot with old Marty and the elephant jumping on a trampoline. Now, at Tackle Trading, our swing trading system is called the STEP system. The STEP system it's an acronym that stands for S is stop loss, T is target, E is entry, and the P is position size. That's the STEP. Now, my buddy Noah put this into an equation called plan. because there's an old rule of thumb in trading. Plan the trade, trade the plan. Plan the trade, trade the plan. Put your prep work in, right? So the planning of a trade is basically getting the numbers we need to get to process the trade, to put in a swing trade. Now, the P stands for price criteria for entry. This is your entry technique. The L stands for your likely profit target. Noah's a very creative individual, and he was a little creative with this acronym. The L stands for your likely profit target. The A stands for always have an exit strategy. That's your stop loss. And then N is never, ever, ever over position size. It's just a gentle reminder that we're not gamblers in the market. We're traders. We want to be consistent. We want to be consistent in our position sizing. There's not a get rich quick mechanism out there, guys. That's not why you come to tackle trading. I can tell you that right now. You come to get the education to be in this market for the next 20 to 30 to 40 years for the rest of your life. You do not come to tackle trading because you think you can go get that winner chicken dinner, one trade where you're going to become rich and get to retire in the next month. That's not who we are at tackle trading. That's not who we will ever be at tackle trading. You come here to get the education, the foundation, so that you can be a trader in the market for the rest of your life. And to be able to do that, you can't over position size. I don't care how good the trade looks, quite frankly. Now, there are a lot of rules that we teach in the step method, the step system, to help you in your terms of your entry, your target, your stop loss. And certainly I would recommend get into the step system, learn that system, learn the rules for swing trading in that system. It's about a 6-hour course. We do a mastermind once a month. By the way, doing it here in about 20 minutes from now. And we basically work on swing trading with one another. And so there's a lot of rules to learn, but here are just some basic hallmark rules. Now, you can certainly take a picture of this screen later on. Okay, you can come watch the recording. You can take a screenshot. Don't mind that in any capacity. But for now, there's really only one question I have here. And the question is ATR. For those of you who have been around the market for a while, ATR is very, very common for you guys. It's very, very common for us. We love ATRs. The reason we love an ATR is because the ATR stands for average true range. It helps us give an understanding of how fast this stock will move on a daily basis. There's a trader one time basically made a statement, asked a question type conversation. And they were talking to me about their swing trading. And I basically said, what are the rules, right? Because that's one of my first questions. Well, what are your rules for swing trading? We all like trends. We all like patterns. We all like support resistance, right? But what are your rules? And I was trying to compare, see if they even had rules to begin with. And he was talking about the rules. And he says, well, I put an entry 10 cents above the high. And I was like, okay, like on a $10 stock? No, it is 10 cents above the high. I'm like, I don't got a problem with above the high. Like that's great. Like that's common technique for confirmation. 10 cents, I have a massive problem with. Massive. It makes no sense. It can't be, it's not repeatable. And I was trying to explain to this gentleman why. And he asked me the question, well, why can't that work? I said, well, it can't work because 10 cents doesn't mean the same thing to every stock. To create a rule, you have to be consistent. And to be consistent, you have to match the volatility or the personality of the stock. And I gave this gentleman an analogy. I said, you know what? I have kids. I got 3 beautiful daughters, and I have a son, my dude Tanyan, my 3 amazing, beautiful daughters that are all going to take over the world one day. And I said, when I've tried to teach them life lessons, analogies, using my experience, I don't talk to them about the same things. I don't give them the same analogies. I don't educate and teach them in the same vein because they're all a little bit different. They're all a little bit different. Some are volatile, some are consistent. Some need a little bit of momentum in their life, a little giddy up and go type scenario. Others need to settle down a little bit, right? All of our children are very, very vastly different. Yours are, mine are, they're all different. They all have unique personalities. You find your way to teach them the best you can, right? But you always try to put it into their language. At least I have. At least I have. And maybe that's the case because that's how I see trading. You can't identify a rule, say 10 cents, 20 cents, $1. They don't mean the same to every stock. $1 to a $10 stock is a 10% movement, and a $1 to a $100 stock is a 1% movement, and $1 to a $1,000 stock is a 0.01% movement. Those are vastly different. If you put an entry $1 above a $10 stock, you probably missed the run. It's probably already overextended. It's the trade's over. You put an entry to order a stock on, before Amazon did a split earlier this year. You're trading a $2,000 stock. $1 to Amazon is nothing. It's like 1/20th of a price movement on an average day. And so we don't use just dollar figures in terms of the rule creation of swing trading principles. We use ATRs because the ATR will customize the rule to fit the personality of the stock. Some stocks are very consistent. Some stocks are very volatile. Mind you, trade the consistent ones, stay away from the volatility ones. But some stocks can move fast, some stocks move slow. You have value stocks, you have growth stocks. Even within value, you have subcategories of value. For example, Microsoft, you can make an argument that Microsoft can be a growth stock sometimes, and you can make an argument that Microsoft can be a value stock sometimes. Why? Because they got a massive division that cashes close to 50 billion quarterly on their online CRMs and their iCloud businesses, the Azure business. And so why do you call it a value? Because they pay us a dividend and it's Microsoft, crying out loud. There's some value and growth to everything. Some are pure growth, some are pure value, but there's a little bit of both of everything in every stock. And so when we're looking at the customization of rules, we use the ATR because the ATR tracks the last 14 trading sessions to give us a statistical measurement of how far a stock can move on a daily basis or on a 5-minute chart, whatever the time frame of the chart we're looking at. And what it does is it doesn't average it out like a moving average where it just uses the closing price. What it will measure is the very high of the day to the very low of the day over 14 bars, 14 candles, 14 days, whatever time frame you want to look at. So the ATR we utilize in almost every rule for the creation of the execution of a swing trade. It's just an indicator that you add to your chart. You don't need to do anything to it. 14 days. The only thing I would suggest is when you first add it to Thinkorswim, if you do use Thinkorswim, the customization of the ATR, if you look at ATR right here, you see 14 and simple. When you first add ATR, it will actually come in as Wilders. And there's not a big difference there, but just make sure to change it to simple. Wilders is a different measurement, just slightly different measurement. But when you're looking at ATR here, it just gives us a understanding of volatility, certainly, but how far a stock will move over the last 14 sessions in the market. So if you look at this number right here, just to kind of teach a little bit about ATRs here tonight, if you got to move the black off there, and let's go to pink. Let's go to hot pink here. When you look at this number right there, okay, ATR 14 simple. If you look at that number right there, it sees 84 cents, right? 83.9. This stock on average moves 84 cents a day from the very high to the very low. Whereas if I'm looking at a bull stock, for example, let's go over to one of our bull lists and let's go to the bull list here. This is the bull list for this week. Let's go to, where are you, Yeti? There we go. Whereas on Yeti here, what do we got? Well, we got an ATR that moves $2.60. And so if I just used a 10 cent rule, well, 10 cents to Yeti, which moves on average $2.60 versus Lucid, which moves, what was Lucid again? 84 cents. Those things are different. They're just different. And so we use ATRs to help us understand the execution of rules. And once again, if you need to understand that a little bit more, which you probably do if you're new, The step system is an awesome, awesome, awesome system for you. Check it out there at Tackle Trading's website. It's on sale right now for the next few weeks, by the way. Looking at Yeti here, let's go back here. Okay. So I just wanted to take a moment just to kind of plan that. Now, when you plan a trade out, when you're sitting down and you've identified a good trend, a good stock, good pattern, setting at support, all of those things are fantastic, right? And so when you've sat down and you're like, I'm ready to prep a trade. This is a process that you can go through. You might have your own one, and that's perfectly fine, but this is a process you can go through. One, two, three, four. The first thing we need to do is we need to identify our entry order. Now, we're going to move with confirmation, which means we're going to go above the high of the day. We'll do this here. And by the way, guys, I know step system is supposed to be starting here like 5 minutes ago. Is it for those pros out there? We'll get started here in about 15 minutes into the step system. If you don't mind, I'll just summarize here just over the next 10 minutes or so. I want to prep a trade on Yeti, and then we'll get into the mastermind group. Come on, Matt, was that the easiest thing to predict of all time that we were going to be a little late going into the step system here tonight, given the fact that it was an hour and a half, and they asked me, Matt Justice, to teach swing trading in an hour. I mean, come on. It was on them, not on me, Matt. Not on me. I kid. It's probably on me. But you know me. I like to be thorough. I like to be thorough in the education. And so when you're planning the trade, you simply look for your entry with confirmation. You look to identify support to put a stop loss underneath support, and your target is going to be wherever you expect it to go, right? That's kind of the process that you look for. Number one, you look for your price entry point. Number two, where do you think it's going to go in the future? That's your target. Number three, what's your exit strategy? That's your stop loss placement, right? Just go through the process. Identify your entry, identify your target, identify your stop loss. Make sure that the reward is substantially greater than the risk. And then obviously never, ever, ever over position. Make sure that you're comfortable with the risk parameters. And with that said, I want to go back into Yeti because Yeti's going to be our trade here. All right. So the first thing I like to get is my entry. I want to get my entry. Now, entry, we talked about this from an entry perspective, but entry, it's not as simple as going above the high of the day. But if you want to look at confirmation as going above the high of the day, that's always going to be a technique you absolutely can utilize. What I like to do, however, is I like to look at the high of the day in conjunction with what's happening over the last few trading sessions from a support or resistance from an intraday perspective. And as you can see, you got a nice little retracement forming here, and it's coming down, 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 down. Now, what do you see over the last 3, 4 trading sessions here? It's just flatlining, right? It's just flatlining. Now, to the naked eye, that might not seem like anything. To the trained trader, that is absolutely everything. It's everything you want to see right now. You want to see a standard pullback in the marketplace when you're coming into pattern number 3, the bullish retracement. You want to see a consistent downward movement in price that doesn't have too much randomness in it, too much volatility in it. Pretty consistent, just downward movement in price. And as the market is coming down, 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 ultimately you want to see that pivot formation. You want to see Marty hit the tramp and form support. Well, that's what's happening over the last few trading sessions is Marty was coming down, 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 down. He comes down into support, and you see how it kind of flatlines here? Marty's taking a nap. That's what's happening. Marty found the trampoline and he's taking a nap. Now, where's the top of Marty? That's where I want to look at here, because do you see where we can look at the high of the day, which is basically this candle here, the high of that candle there? But that's over the last few trading sessions is just in a little bit of neutrality between this pivot point right there at resistance and these two double bottoms at support. So do you see the old resistance here? Oh, excuse me, old support here? A little wick analysis there, kind of a little bit of a top over there. I need to see it break out of that level. I need to see that go above that box. You go above that box, that's confirmation. And so the high of those price tag, and you got to identify that. We just got to give it a number. We're going to give it 41.6. And so we're going to say we need to get it above 41.6. Ilka, or would you do theta trade instead of delta? Ilka? Here's rule number one when it comes to any directional trade. Any directional trade that is worthy of a swing trade or prepping that trade is absolutely good enough for a theta trade. That's the rule. That's a belief almost every trader has, because if it's good enough for delta, which is, the assassin-like mentality, right? You got to be accurate there. It's certainly good enough if you're going to lob some grenades called bull put spreads or bear call spreads or covered calls. And so typically speaking, yes, if it's good enough for delta, it's an amazing theta. If it's not good enough for delta, it can still be a really good theta though. So yes, if it's good enough for delta, it's absolutely good enough for theta. And that is just the way traders, we talk at Tackle Trading. Delta stands for direction. Theta is code for cash flow strategies. And so, okay, yes, I would agree with that. Now, as a swing trade, obviously, I'd be looking at delta. Most theta trades are more of the theta. Most theta trades, I personally would categorize as a position trade more than a swing trade. So in swing trading, I definitely look in delta on this type of pattern. But for those, like Mark's not a delta trader. Mark is more of a cash flow trader. Emily, more of a cash flow trader. They'll take the same setups and they'll just lob a bull put spread or do some type of naked put or something along those lines. And so it's one of the reasons why I love the options report so much is that, the delta dogs out there at Tackle, they can certainly use those watch lists to track delta trades. But the theta traders, they love the options watch list because they know they can get the liquidity. They know two things. Number one, that it's good enough for a delta trade. And if it's good enough for a delta trade, it's great for a theta trade. That's kind of the mindset. And then number two, they know because it's on the options report, you have the liquidity necessary to do any type of trading system on it, because we know our traders at Tackle don't just buy call options. They'll do a lot of spreads. They'll do a lot of verticals, a lot of horizontals. And so liquidity becomes very important for us when we're adding stocks on our options report. So that's kind of those two rules. Yeah, it's good for theta, the options report good for theta, but you have the confidence you can apply any trading system on it because you got necessary liquidity on there. Appreciate the question there, Ilka. Now, in terms of looking at this, let's kind of come out just a little bit here. Okay, so now let's just go through the process here. Number one, we have a bullish uptrend. How do I know that? Because it broke out and established a higher level of resistance than the previous level of resistance. You can debate a lot of things in the market. You can't debate what I just said. It's historically accurate. The market just broke out. It established a higher level of resistance, and now you're sitting at a higher level of support. Those things are not debatable, right? Where the price goes in the future, we can debate that, but you can't debate what did occur. That just occurred. We have a higher level of resistance right here based on this catalyst down there called the earnings, gap runner. Now, we already looked at the intraday. You see Marty coming down, 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 down. Well, now as he comes into the trampoline called the 9 EMA, not shocking, by the way, as he comes into that trampoline called the 9 EMA, it's starting to flatline. And so we're looking to get in above 4160. And we're going to use just 10% of the ATR. And so the ATR, once again, it's down here, guys. The ATR on this current stock is $2.60. So 10% of the ATR is about 26 cents. 26 cents above 4160, which we identified as the intraday resistance level we need to trigger above to get confirmation, would be 41.86. So we're going to put an entry at 41.86. And I'm just going to use an alert here to illustrate the order, but that order would be called a buy stop order is what it would be called. You'd probably do a buy stop limit just to kind of lock in that if you're not trading during the actual trading session, but you're putting in the order in overnight, you'd probably use a buy stop limit order, but I'm just going to put a buy stop alert to illustrate the point. 41.86, that's based on 10% of the ATR above the current price, which is right here. So if the market just stabilizes here and does nothing, we don't care. If the market, if I'm wrong on my assessment and support doesn't hold and it goes back down, guess what? I don't care. I only care if it confirms and comes back down. Then we have something to talk about. Then I'm going to complain. Then we're all going to complain. But until it does that, there's nothing to see here. It's either going to go there or it's not. And if it goes there, we got confirmation. If something else occurs 2, 3, 4 days from now that stops the movement, that's trading. That's trading. But we got what we asked for. We got our confirmation. Now, what we also like about the creation of support, which is what you're currently seeing here in Yeti, is we can put a stop loss under support. And so we're going to put a stop loss underneath $40, which is where I'm going to identify support. I'm going to use 25% of the ATR. So 25% of the ATR is going to be right around 65 cents. And so I'm going to put a stop loss at 39.35. And so once again, I'm just going to put an alert here at 31. Oh, not 30, 39.35 to illustrate the stop loss. So my risk on this trade is from my entry, if I get triggered, down to my stop loss, which is right about $2.50. Okay. Well, where do we expect this stock to go? Now, guys, I can tighten these entries up. I'm just illustrating a one set rule on one trade. We can tighten these up if I'm not comfortable with the $2.50, but I'm pretty comfortable with it. And so when we're looking at this here, our risk is from our entry to our stop loss. Where is our potential return? Where we expect it to go. Now, where we expect it to go is a much deeper conversation than the introductory webinar teaching people the basics of swing trading. But what I'm going to say is it's going to go to my T2 target of $50. Okay. T1 target would be the previous level of resistance. That's right here at $46. My T2 target up here at $50, right where the 50 period on the weekly average is. And so I'm going to put an alert at that 50 period, excuse me, at the $50 mark to illustrate my target. Okay. Now, that is how you prep a trade. You first identify trend pattern, support, resistance. You get all your basic analysis done. Then you identify your numbers, where you're going to trigger off your entry and your stop loss. Then you simply prep the trade. The last thing to do, and by the way, it takes traders a heck of a lot longer to teach it than it does to apply it. But the last thing we do is we simply define how many shares to trade, how many contracts to trade, and we place the trade. So my last question is this, guys. First of all, have you guys had fun tonight? Did you learn something tonight? Because that's what real financial education is all about. Learning, growing, having fun, but enhancing your skill set. Whenever we come to even a beginner level webinar, which it's from Coach Matt, it's not exactly going to be beginner level, but whenever we come to these scenarios, we always want to learn. We always want to grow. We always want to take a technique that we've learned that we can start applying on a daily basis. And I know we went a little bit longer here tonight, but then again, we are also launching our holiday sales season, and we're also detailing not just a single concept of support, but we're talking about swing trading in general, support and resistance, trends, patterns. My dog's also telling me it wants to, Rosie, calm down. Okay, so in terms of the last question I have for you guys here tonight in the general session is simply this. When you're looking at a potential trade, okay, and we've already prepped the trade. When you're looking at a potential trade here, my last question is really, really, really simple. Really simple. If I'm right on my trade, okay, if I'm right on my analysis, and we buy a call option, and that call option costs us $430. How many of you could use an extra $556 per contract over the course of the next 2 weeks? Could that help anybody out here a little bit? Could that help maybe put some food on the table? Maybe not complain about as much about inflation. Don't get me wrong. I complain about inflation too all the time. I enjoy complaining about things that other people do. But in terms, $500 per contract, I'll take that. Now, the question is this: how many of you are willing to risk $100 to make the $500 on a trade that looks like that? Go or don't, Yeti. It doesn't matter. Go or not. But that's what trading is, ladies and gentlemen. You've been watching Tackle Trading 101 on Swing Trading with Coach Matt. It's been an absolute pleasure to be with you guys here tonight. It's not as easy as what old Jesse said 100 years ago, but yes, certainly buy rising stocks and absolutely sell losing stocks. But if you are new to tackle trading, and first and foremost, if you've enjoyed the webinar here tonight and you've got some value out of it, give us a like and share. Tell somebody about it. Tackle trading, we get more out of word of mouth and people talking about us than our what we do on social media and so on and so forth. So we really do appreciate all of you guys liking and sharing and helping us get the good word of tackle trading out there into more eyes and ears of other people that could get quality financial education. For those of you who are newer to trading in general, for those of you coming back to trading after a break, whether that break was short or long, you've been a part of Tackle before, welcome back, number one. We've all taken breaks from trading, and it's always good to come back and coming back to a community that you know and that you understand and you understand the language. It's always great to see traders of the past come back. So if you're ready to come back to the market, come back to Tackle Trading, no doubt about that. First and foremost, you can always join Tackle Trading as a pro member by simply going to bit.ly/join Tackle Pro. You can get a 15-day free trial and test out everything we do at Tackle Trading from a pro membership, the scouting reports. We have a lot of 101s and we do a lot of webinars for our pro member community as well. If you're ready for more deeper, more consistent education, you want to work one-on-one with one of the Tackle Trading coaches, which is about as good a mentoring as you will get out there. And the value is there to be had, no doubt about that. We have started our holiday sale season as well, where we have discounted all of our tackle trading products. I'm going to click the link here and I'm going to go to the website just very quickly. But as you can see, we run our holiday sale season. We don't like to put pressure on our community in any capacity. You guys know who we are and you know how we get down. So when you're ready to upgrade into an annual, or you want to change your monthly subscription into an annual, or you're ready to add on a different premium system, you can always let us know. You can come to the website, obviously. bit.ly/tackle holiday is the website there. But when you go to the website here, you can see we run this throughout our entire holiday sale season, guys. Historically, we did a Black Friday deal, and then we would do a Christmas deal, and then we would do a New Year's deal, and then I got sick and tired of it. And so I just said, after Thanksgiving, all the way through the new year, you need something from Tackle, it's there for you. And so you can come, as you can see, you can get a deep discount on your pro member annual, so you don't have to worry about it. Just upgrade to the annual, you're good to go. Coaching here, guys, $1,000 off coaching. You can also schedule a consultation with Sylvia to talk about your one-on-one needs for coaching if the coaching program is a fit for you. And typically it is. There's no doubt about that. We love our coaches. Our coaches you can work one-on-one with, whether it's Coach M, Tyler, it doesn't matter. All the coaches of tackle trading are amazing. I would definitely schedule a consultation to sit down with Sylvia to see if coaching is for you. We obviously have a lot of our other trading labs and premium systems on discount as well. We put out a lot of content from a premium system perspective. If you know what you want, you can just go get it. If you need some help, you need to talk to Sylvia, just come to the coaching program, schedule that consultation. You can schedule that consultation, pick a time. Sylvia will reach out to you. No doubt about that. This class right here, the option success training, it's the one with the deep discount. It always has a deep discount. This option success training is a 5.5-hour class that is chock full of awesome content, guys. I would highly recommend the option success training for anybody at tackle trading. I don't care if you're new, if you're a veteran. I did the option success training just about 3 months ago. I put together the on-demand. It's got technical analysis in it, options training in it. It's got protection, cash flow, you name it. It's a very, very well-rounded understanding of the options market. I love this class. I think it's probably value for bang for value. It's an awesome value, guys. No doubt about that. But once again, there's a lot of ways to go through education at tackle trading, whether it's just a pro membership and you go through self-paced education, or you want something a little bit more consistent, working one-on-one with the coach. Once again, we got it all, and you can set up your consultation at tackletrain.com/schedule-consultation as well. Ladies and gentlemen, I got a step system webinar I'm 25 minutes late for, but thankfully I got a lot of my step system traders that know I'm in here teaching right now. So I appreciate that patience. But with that said, we're gonna continue the conversation that we're ending here today in the pro membership. We're gonna go into a step system mastermind right now. We're gonna have a conversation on really dialing in that number two pattern. What is the high base? What is the flag? What is the retracement? And answering a very, very important question. When do you know a retracement is no longer a retracement? When is it too deep to even track? We're going to get into that conversation here in just, guys, if you can give me 10 minutes, get a glass of water, use the bathroom, I'll be back ready to rock and roll. I will be putting the link in Discord. It's also on the calendar on our website. I'll put the link in Discord as well if you need that. 10 minutes, we're going to start the Step System Mastermind group. Come check it out. If you are not a member of Tackle Trading, you want to check out that Step System Mastermind, let me rephrase. You definitely want to check out that Step System Mastermind. We can always check out the recording after you sign up for a pro membership. You guys are the best. Love you guys. You guys stay awesome. Tackle Trading. I'll see those members in the Step System Swing Trading Mastermind group here in just about 10 minutes. You guys are the best. Appreciate that. And apologize for going too long here tonight, but I kind of knew it. This is just a topic I love talking about. I hope you guys enjoyed it as much as I did giving it.